This is a Sales Geek Academia to Business Translation production. Welcome to the Deep Dive. Today, we're really tackling something crucial for sales leaders.
Right.
Getting opportunity assessment right. It drives, well, everything, doesn't it? Resource allocation, forecasting.
Absolutely. It's fundamental.
But here's the kicker. Less than half of forecasted deals actually close as planned. That's a huge gap. Why? What's causing this, disconnect between our predictions and reality?
That gap is exactly what we're digging into. We're looking at some really compelling research on how salespeople and their managers make these crucial decisions about future deals.
And how they might differ.
Precisely. Especially focusing on those decision-making biases. We all encounter optimism, confidence, maybe a bit too much confidence, or overconfidence. We're drawing from a great study, actually 3 studies, using real CRM data from a big Fortune 500 medical company, let's call them Medco.
Okay, so rich data. And our goal here is clear. Translate this academic work into practical, actionable insights you can use, starting now, to sharpen those forecasts and make sure your team's efforts are hitting the mark. Right, let's unpack this then. These biases, optimism, confidence, overconfidence. Can you break them down? Like, what do they actually look like in a day-to-day sales environment?
Good question. Let's start with optimism. Now, this isn't just, having a sunny disposition. In this research context, it's more like a tendency to really focus on the good outcomes, maybe glossing over the risks. Some call it wishful thinking.
Like chasing that rainbow deal.
Exactly.
Yep.
Spending time on low probability deals because you want them to close, not because the evidence supports it. Unchecked, it becomes a real drain on resources.
Makes sense. What about confidence?
Confidence is simpler. It's just how certain you feel about closing that deal, your gut feeling, that conviction level. I'm 80% sure this one's coming in. It's your internal prediction before the fact.
Okay, so belief in the outcome. And the tricky one, overconfidence.
Right, overconfidence. This is where your level of confidence is way higher than your actual accuracy warrants. You feel 80% sure, but realistically, based on all factors, maybe it's only a 40% chance.
Ouch.
Yeah. It's that overestimation of success probability. That's where forecasts really start to go sideways. You can be confident, which is good, but overconfidence leads to bad decisions.
So these aren't just psych terms. They're real factors messing with our pipelines. If you've seen deals just vanish, these biases are likely playing a part. It changes how deals are chased and definitely how they get reported up the chain.
Absolutely.
Okay, so we know what they are, but the research dug deeper, right, into why. You mentioned 2 theories, strategic reference point and psychological momentum. Can you walk us through those? They sound pretty powerful.
They really are. Let's take strategic reference point theory, or SRP. Basically, it says we use past events as anchors or reference points to judge current situations and predict what's next.
Like looking back to look forward.
Kind of, but here's the bias embedded in it. We tend to recall positive past events much more vividly and accurately than the negative ones. So a salesperson remembers that huge win they closed last quarter, and that feeling, that success, becomes their main reference for the next deal, even if the circumstances are totally different. It can skew their judgment.
I can see that. And psychological momentum. I think I know this from sport.
Exactly. It's that hot streak idea. Psychological momentum, PM theory, suggests that past success fuels belief in future success. You close a few deals, you start feeling like you can't miss.
You feel unstoppable.
Right. It boosts your confidence, your sense of efficacy. What's cool here is applying this known sports concept rigorously to sales for, pretty much the first time in this kind of study. It shows that internal feeling of momentum can directly impact how salespeople assess external opportunities.
That's fascinating. Okay, so we have the biases, we have the theories explaining them. What does this mean practically? Do salespeople and managers really see opportunities through different lenses because of this?
Oh, absolutely. This study's found really significant differences. This is where it gets actionable for leaders.
Okay, lay it on us.
So, study 1 looked at the impact of recent success. It found, maybe unsurprisingly, that higher year-to-date performance boosts a salesperson's confidence. Okay, fine. But it also nudged up their optimism and, crucially, their overconfidence.
Right.
But here's the twist, the really surprising part. Salespeople hitting, say, 105% of their quota, your top performers, were actually worse at accurately assessing future deals compared to those performing lower, maybe around 94% of quota.
Wait, hang on. The person crushing their numbers is less accurate in predicting the next win. That feels wrong somehow.
It feels counterintuitive, right? But the data showed they became significantly more overconfident. Their overconfidence index jumped to 1.56 compared to 1.38 for the lower performers. Basically, their confidence was over 1.5 times their actual predictive accuracy.
Oh.
Yeah, it suggests there might be this optimal zone for momentum. Too much success might actually cloud judgment. Success becomes a kind of blind spot.
Okay, that's a huge takeaway already. What else?
Then study 2 looked at recalling past experiences. It confirmed that SRP theory, salespeople leaned heavily on past positive experiences 68% of the time when evaluating new deals. Managers did too, but less so, only 59% of the time. Salespeople are really focusing on those wins.
Got it.
And that same study 2, also measured the overall biases. Consistently, salespeople showed higher levels of optimism, confidence, and overconfidence compared to managers.
Like significantly higher.
Yes. For example, reps predicted about 7.5 successes out of 10 hypothetical scenarios. Managers predicted closer to 6.3. Confidence. Salespeople averaged 77%, managers 68%. And the big one, overconfidence. Salespeople were 24% overconfident on average. Managers, only 14%.
24%. That's almost double the manager's rate, that 10-point gap.
Nope.
That's where forecasts go completely off the rails, isn't it? That's the difference between hope and reality in the pipeline.
It's a massive difference in practical terms. And finally, study 3 looked at how opportunity size affects things. This is about concrete deal info. For salespeople, just knowing the size of the potential deal, the hospital size, the contract value significantly boosted their optimism and confidence.
Bigger deal, bigger confidence.
Seems like it. If they didn't know the size, their optimism and confidence dropped. But for sales managers, knowing the deal size didn't statistically change their optimism or confidence levels much at all.
Interesting. So managers see it as just one piece of data.
Exactly. They seem to use it as one input among many, showing a more measured, deliberate approach. It fits the picture. Salespeople focus on the reward, the potential win, while managers are weighing a broader set of factors.
And you mentioned earlier it's not about risk-taking appetite, right? The study found they were similar there.
Correct. No significant difference in risk propensity. It really points to these cognitive biases and the different reference points they use as the key drivers. Oh, and managers also rated competitor info as more important than salespeople did, another sign of that wider perspective.
Okay, this paints a really clear, data-backed picture. The core problem is that these inherent biases, especially in our successful reps, lead straight to inaccurate forecasts and wasted resources. So, connecting all these dots, how can sales leaders listening right now use these insights to actually fix this? What are the actionable steps?
Right, the what do we do now part. The research points to 3 pretty clear actions.
Let's hear them.
First, actively coach for balanced evaluation. Managers need to be more hands-on here. Coach your reps to look at all the factors, the pros and the cons, and crucially, prompt them to think about past losses as well as past wins when sizing up a new opportunity. Bring some balance to that internal reference point system.
Okay, more balanced coaching. Makes sense. Number 2.
Second, mandate collaborative targeting. Get managers working more closely with their reps on which customers to target strategically before the chase begins. It's not micromanagement. It's using the manager's generally more objective viewpoint to counterbalance the salesperson's natural optimism early on. Leads to more realistic assessments from the get-go.
Collaboration is a bias buster. I like it. And the third?
Third, elevate CRM data responsibility. This is key for forecasting. Empower, maybe even require sales managers to take more ownership of verifying and perhaps even inputting critical opportunity data like deal values, close probabilities. Managers are just better positioned, according to this research, to provide that objective overlay.
So managers act as the reality check within the CRM.
Essentially, yes. Grounding those forecasts in a more objective assessment, not just the salesperson's potentially overconfident view.
Fantastic. Coach for balance, collaborate on targeting, and get managers owning that CRM data integrity. Really concrete stuff. So here's a final thought to leave everyone with. Considering all this, how can you as a leader build a sales culture where maybe, just maybe, realistic assessment gets celebrated just as much as hitting those stretch targets? How do you make accuracy as valued as ambition to drive more sustainable, predictable growth? Something to chew on. You've been listening to The Deep Dive, brought to you by Sales Geek. We translate research into results. Thanks for tuning in.